Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to be talking about credit reports. So, we're going to be talking about how to properly analyze credit reports and look at credit simulations, which is definitely something that all loan officers need to know about and know how to do. Give us just a moment here to go live on all the different platforms. I appreciate everybody tuning in nice and early. Go ahead and drop a comment there in the chat. Definitely appreciate it. So it looks like we are live now on all the different platforms. So we'll go ahead and we will get it started. We'll take the chat off the screen for now. We'll go ahead and keep dropping comments there in the chat. You can also drop any questions that you have for Jose in the chat as he goes through the presentation here today. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender that specializes in non-QM loans. And what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern on the show is go through a new loan officer training topic. And tonight we're going to talk about credit reports and credit simulation. So I will let the master Jose take over here, talk about the importance of this and how we can do it.
Good evening, everybody. Thank you for joining us for tonight's training on credit report review fundamentals, right? We want to train you so that you know how to identify different issues and opportunities in the credit report, especially credit simulation opportunities, which could make or break your deal, right? How many times has a credit simulation not been attempted and then all of a sudden you're 2 points short from the next level because something just happened with your loan, guidelines change, whatever may have happened, and now all of a sudden you're in limbo. So we always want to be proactive in reviewing the credit report and identifying any opportunities that the borrower may have to increase their credit score, which may also allow them to increase their LTV and decrease the interest rate and the cost on the rate, right? So let's get right into it. Now, it's ironic because today, so I was questioned by some MLOs about if we had any credit report repair company that we can recommend. We don't usually like to do that. What we do like to do is be loan consultants and understand what may be causing the issues to the borrower's credit so that we can properly explain it to the borrower and so that they can take the necessary action. Usually, that's all that is needed to assist the borrower with their credit report and their credit scores. So let's get a little history on credit reports. When did they actually come about? Well, the attempts to standardize the credit reporting process dates back to 1841 when the Mercantile Agency was founded. That was the first attempt at quantifying the data. Now, the first standardized credit score, the FICO score, was introduced in 1989. Seems like it's been around a lot longer than that. But prior to 1989, we didn't really have FICO scores, credit scores. So Equifax and TransUnion followed soon thereafter. So that was Experian that came out with the FICO score. Now, what did this credit scoring system allow? Well, it eliminated subjective review of borrower credit, right? It's very important that we look at borrower credit in an objective point of view. So they form the credit score model, which we're going to discuss in the next slide as to how that model analyzes the credit. Having these credit scoring models and credit reports also sped up the loan approval process and increased origination output, right? That's good stuff for us, MLOs, right? We're talking about adding systems here. It allowed automation, scaling, and increased profit. And as if you all wouldn't know already, Equifax, Experian, and TransUnion are the three credit bureaus used. But what you need to understand is that each credit bureau has their own algorithm to interpret the data. So and I'm sure that's why the scores are different in all three bureaus. Uh, and I'm sure you've seen this before where like one account may not report to one bureau, it reports to another bureau. So they could only have one account and the three bureaus report three different scores because they analyze the data differently. So, what are the score ranges, right? And how can it impact our loan origination? Well, anything 750 or above, you can consider that excellent. Best pricing and loan to value on all of our products, especially non-QM products, is available with a 740 plus credit score. 700 to 749 is considered good. Still, many loan options. However, below 700, uh, we have a lot of options that get cut off. So it seems like 700 is a very critical number. 650 to 699 is going to be fair, considered fair credit. Be aware that 660 is a cutoff for many non-QM options. So you'll see below 660, LTVs drop drastically for a lot of non-QM options like our bank statement loans and our DSCR loans, for example. 600 to 649 would be considered poor credit. Uh, Conventional minimum FICO score is 620 per the matrix, even though it's going to tell you minimum FICO determined by AUS, and then you got to worry about mortgage insurance. Non-QM options are going to be available between the 600 and the 649, but they're going to be limited and at reduced LTVs. And below 600, that's you could pretty much consider that bad credit. Now there are still options, but for example, FHA automated underwriting will require an LTV at 90% or below. When at 90% when the FICO is 580 or below. You're also below 600 going to have limited VA and USDA options and very limited non-QM options. We do have options on non-QM down to a 575 credit score. Our DSCR options, for example, go up to a 65% LTV down to at a 575 credit score. So these are your credit score ranges. Now, what we're getting into here is the parts of the lesson that's going to allow you to be the consultant to understand why, when you're reviewing the credit report, why are certain, why is the score reflecting what it's reflecting? So you got to understand then the following components that make up the credit scoring models. Payment history makes up 35% of the score. Payment history is affected by late payments. Credit utilization, the percentage of their credit that they're using, right, which is basically available credit, which is your total limit, versus utilization, which is the amount being used. So high balance to limit ratio is going to affect your credit utilization. In other words, if the balance is $900 and the limit's 1,000, you're at 90%. That's a very high utilization ratio. The length of credit history is 15% of the scoring model, and that is affected by the age of the accounts. Reason being, those accounts, the longer that they've been around, the more payment history that you can review, right? So it adds more weight to the longer they've been making payments. So length of history is 15%. Now, credit mix, right? So it's 10% of the total, and credit mix is affected by the types of accounts in use, right? Depending, is it installment accounts which are secured, or are they revolving accounts, which are unsecured? And then new or recent credit accounts makes up 10% of the scoring model. This is affected by new accounts, which have a limited payment history. So if you got some new accounts, you're going to see a drop in the credit for at least 3, 4, 5, 6 months until there is enough of a payment history established so that the score can go back up. So again, payment history 35%, credit utilization 30, length of credit history 15, credit mix 10%, new and recent credit 10% of the action. So now once we are reviewing the credit report, we have to review it for accuracy. So you want to review the data for accuracy and for alerts. The system itself will give you different alerts. So you want to ensure that the borrower information is correct, uh, because incorrect information on a credit report, and I'm not just referring to the social security number because that's an obvious, but I'm talking about things like date of birth, uh, where they live, their residence address, their if they use their complete name, including middle name or middle initial. Um, these are different. These are different items that if they are misspelled, if the data is different, it may not pick up the complete borrower credit file. So you want to make sure that you have their correct address, correct date of birth, obviously correct social security number, correct spelling of their name, all of those things. And if they've lived at a prior address, system will sometimes ask you, prior address to this one. Okay, put that one in too because that credit may be coming up under that prior address as well. So remember, any errors in this data could skew the information you receive in your report. Now, you want to review the report for red flags and alerts, like, again, the easy ones, social security number mismatch or issue date, not just for purposes of accuracy of the data, but, just to see if there could be anything going on, like it's not really the borrower's information, you know. Uh, so again, social security number mismatch. Issue date would mean that social security was issued within the last 10 years, which could be an alert, right? If they say they've lived here for 20 or 25 years and the social security number only issued 10 years ago, maybe it's not their social security number or maybe it's a mistake. So just keep an eye on that. Address mismatches, identity theft freezes. So if there is an identity theft alert on their credit, make sure they are who they say they are, right? Reviewing their identification. And excessive credit inquiries. If this borrower has 15, 20 credit inquiries in the last 10 days, what's really going on here, right? Make sure there's no funny business. Could just be that unfortunately they're letting everybody who they talk to pull their credit, which is what they shouldn't do. But just keep an eye out for those red flags and alerts because there could be fraud. Now, you want to identify any of these errors, have them corrected, and make sure that you address the concerns with the borrower because some of these corrections may need to be done at the bureau level and not just locally with the credit reporting agency who you use to pull the report. Now, when you are reviewing the report, besides looking at data accuracy, you also want to review the report and see what it actually contains. You want to review the number of trade lines and the length of time that those trade lines have been opened. The credit is not just about credit scores, as you all know. Now, there are scenarios with some of our options in the non QM world that if the borrower has 3 credit scores reporting, then the number of open trade lines is not an issue. But that is a case by case situation, and some guidelines do ask for a certain number of trade lines, and others will state if they have 3 credit scores, don't worry about how many open trade lines they have. So again, you want to review the trade lines. You want to see how they're being handled, right? Especially mortgages, which would be housing history, because most of the non-QM programs, especially, are going to look at how have you been paying your mortgage the last 12 months. So definitely, you want to look at all of those, and you want to look at to see if there's any credit events, right? Are there any bankruptcies, foreclosures, short sales, or anything like that that you can identify in the credit report? And very importantly, this is one people tend to miss, but could come back and haunt them, is look for disputed accounts, especially those disputed accounts with a balance. Why do I state this? Well, it's all about the guidelines again. Because if you don't notice that there's any disputed accounts on there, right, and then you go, everything's great, full speed ahead, run, take borrower submits loan application gets submitted to DU, you get the approve eligible, but you didn't know that there was a disputed account until you read the findings, and the findings say could say one of two things. We noted that there's a disputed account. We were able to provide the approve eligible with reviewing that disputed account. No further action required from the borrower, or it may say we cannot determine the information if they actually qualify because of the disputed account, and because of that, you have to downgrade your approval and submit manual underwrite, which we don't really have any options manual underwrite for conventional loans. That's what it would tell you in a conventional loan. On an FHA loan, it's written in the verbiage and the findings. Any disputed account or accounts totaling $1,000 or under $1,000, you don't have to worry about it. Continue, no harm, no foul, if the system gave you the approved eligible. However, if the total amount of the disputed accounts is over $1,000, now all of a sudden your approved eligible is downgraded to a manual underwrite, which is max 43% DTI and not 56.9. Other considerations that it throws at you that you might not be able to meet. So look for those disputed accounts. Oh, and in non-QM, it's all about the guidelines. Most non-QM, they're going to treat disputed accounts differently. Some will tell you you need to bring the balance down to at least 250 of that disputed account, and then we don't have to consider it. However, the issue with disputed accounts is if you need automated underwriting approval to pick up the fact that there's no longer a disputed account, then those disputed accounts need to be removed from the credit report via a rapid rescore after the customer has the account dispute removed from the account. Could take a bit to get that taken care of. So you want to make sure that you don't miss the disputed accounts on the credit report. That's one of the ones that could really come back and bite you and ruin your deal. So again, remember, for AUS approval, disputed accounts will need to be removed via a rapid rescore. So now we've talked about the components of credit, how they can be affected. We talked about looking at errors and how those things could affect scores. So now we need to identify the credit simulation opportunities. Now be aware of the following. Every credit report that we pull at the mortgage calculator includes the option to run two different types of credit simulations. Credit simulations are a way to see what potential there is for the borrower to increase their credit score. Now, the two simulations that we have at our disposal, one is the Wayfinder and the other is the What If. Now, be aware that the Wayfinder is a computer algorithm that searches for the best path to a desired credit score goal. It's only going to work as good as you configure it, right? So you have to be aware that the Wayfinder comes preset with certain maximum amounts that you could spend per account. So unless you go and you reconfigure the maximum that you'll let Wayfinder tell you to spend on one account, it may tell you you have to pay off, or pay down or do something with 9 accounts that could have been accomplished with one, because it was 6,000 to one account, 9,000 to another, instead of $1,500 to 8 or 9 accounts because of the limit who could have been set at $1,500. So that's real important about the Wayfinder. And the what if is the one that gives you, the MLO, more discretion as to what accounts to be paid off, because you can go to the account, put a certain balance in that account, and see what impact that has, lowering that balance on the credit score. So that's why I really like the what if. I may use the Wayfinder just as an initial guide, but then I'm going to go to the what if to fine tune the simulation. Again, the borrower may have already paid some accounts down, so then you may also want to ask them what are the new balances. Well, you can plug in the new balances in the what if to see what their credit score would be now when you pull it. So the goal of the credit simulation is to increase the middle score. Now, I got to say that because when you're looking to increase one score, you want to make sure that's what you have to be aware of. That you have to make sure that whatever score you increase, when it gets to whatever number it's getting, that is numerically the middle score. So, for example, like in the bullet point I have there, if the goal is 660 and the scores are Experian with a 630, Equifax with a 650, and TransUnion with a 657, then the MLO is going to need to rescore 2 of the accounts. In this case, we're going to have them do Equifax at a 650 and TransUnion at a 657 to ensure that our middle score is going to be at least a 660. And you could have picked Experian instead of Equifax, for example. It really depends what the simulation told you. Sometimes you're going to get more juice with one over the other when you're playing with the accounts, and you're not going to know that until you start doing the what if. But keep in mind then that you want to be numerically in the middle when the dust settles. Keep in mind that rapid rescores can be completed in 5 to 7 days. Sometimes they can be done a little bit quicker, especially if you pay a little extra for a rush. I've had them done in 24 hours. But they're only as good as the data that you give them. To do a rapid rescore, you need to provide certain information, certain letters, certain documentation. That if the documentation doesn't work, the rapid rescore will be rejected, and you got to try again. And then you need to pull a new credit report to obtain the new scores. And most importantly, MLOs be aware, because I sometimes see these rapid rescore suggestions MLOs have sent to borrowers with like paying down 13 accounts. And I've asked the MLO, I said, by the way, are you aware that you got to pay for that rescore of 13 accounts, and that's going to cost you like $600 or $700? And they're like, no, I wasn't aware that I had to pay for it. I'm like, yep, it's not the customer. You're going to pay for it. So try to really make sure that the rescore that you're offering is the shortest and most direct path to the objective, because the borrower cannot pay for the cost of the rescore. So now you've identified simulation opportunities. You've suggested them. The borrower did what you told them to do per the rescore. You now obtained the letters for the rescore. So now, what do you do to update the credit report data? Well, we've been talking about rescores, right? But in actuality, credit report data is updated in one of 2 ways, depending what you need, right? If you do not need the information to be picked up by any type of automated underwriting, it's just the underwriter wants to see it on the report for their own calculations, then you would do a credit supplement. A credit supplement is an update of the account information at the credit reporting agency level only, and will not be picked up by AUS. So, for example, we use CIC as our credit reporting agency, so we would request CIC to complete a credit supplement. When they complete a credit supplement, they call the account, who it may be. In this case, maybe it's a credit supplement to update the payment history on a mortgage trade line through the date of closing, which is a very common requirement. So then CIC Credit will call ABC Mortgage Company. They may have to do it with the borrower on the line via a conference call, depending on the requirements of the mortgage company. And then they will verify the payment history, right? The amount, the balance, if they're on time, any late payments, and when was the last payment made. That would be a credit supplement at the agency level only. Now, if you need to change to appear at the bureau level, at the Equifax, Experian, TransUnion, so that automated underwriting picks up the change, which is critical, then you need to do a rapid rescore. That's where you would do the rapid rescore, for example, to remove the dispute after the customer has the dispute removed and provides the letter from the creditor that says here from ABC creditor John Smith no longer has a dispute on that account for XYZ. Then that letter is the letter that gets sent to the bureau so that then the information can be pushed in a short amount of time and appear. And once it appears, then you pull the new credit report to get the new credit scores. So rapid rescores are for process where the data is pushed to the bureau level, allowing AUS to pick up the changes. And again, costs cannot be paid by the borrower. Usually takes 3 to 5 days to process unless you pay for a rush. Now, some of the common, which I just alluded to, updating that is requested, the most common one is mortgage trade line updates. Mortgage trade lines are going to be updated in one of two ways. Either, or they're going to ask for one of two things. They're either going to ask for a payment history that needs to be updated for an existing account that's reporting on their credit report. Usually credit reports are behind anywhere from 1 to 2 months on the data. So right now there could be maybe a reporting date of April, and you need it, if you're closing in June, a reporting date of at least May, right? So if that's the case, then you're going to request a credit supplement to update the trade line at the agency level. However, if the mortgage does not appear on the borrower's credit report, then you need to have that trade line added via a credit supplement. That's going to be the add a trade line, where again you also provide the information, and then they will call the trade line, verify the data, and then put it on the credit supplement, and your credit report will be updated at the agency level. Again, if these trade lines need to be picked up by AUS, then you're going to have these trade lines added via a rapid rescore. So now, last but not least here, right, is the guidance to the borrowers, right? Now, we already talked credit simulation. We already talked all that stuff with them. But what is the basic guidance you want to give to your borrowers at the time that they're contemplating the application? Well, some of the stuff is pretty basic, others is not, but we'll get into it anyhow. Uh, Inactive credit card accounts. This is something people don't realize, but you're going to have credit cards, and if you don't use them, even if they're on a zero balance, your credit score will go down because there's no payment history to consider. So make sure that they're using their credit cards for at least incidental expenses like gasoline, and then paying them off where they were. We're not telling them run up your credit cards. We're just telling them make sure you're using all your credit cards so that there's payment history that can be considered for each card. I mean, I've seen this not using the credit cards lower a borrower's credit score 50, 60 points, and then all of a sudden starting to use them again, credit jumps again. Do not open any new accounts. We already saw in the credit scoring model, new accounts, when they're open, they're going to lower your credit score simply because they're new, limited payment history. Do not increase credit card balances. That's another obvious one, but we want to tell them anyhow because of the proportion, your utilization basically is why. If you increase your utilization, you're going to decrease your credit score. Now, the borrower can ask the creditors to increase the credit limit on their existing accounts because now, if they increase the limit and keep the balance the same, they're going to decrease their utilization and then hopefully increase their credit score. Do not close any accounts if they are paid down or paid down to zero. That's critical. Pay them down to zero, but don't close them because if you close them, you not only eliminate the payment history and length of time of the account being open that was attributed to that account if you've had it for a while, but then you will also decrease, or actually, you will decrease your balance limit available and you'll increase your utilization. Simply closing an account down, if you had $10,000 in available limit and 5,000 in use, and you're 50%, and you close down that account that had 5,000 in limit but zero use, now you're at 100% utilization. And now you got 5,000 limit and 5,000 use. So now your credit's going to drop to like 600, 580s if you're at a 100% utilization. Here's one that I've seen, been able to take advantage of a few times. Have the borrower consider being removed from high balance authorized user accounts, right? Those don't add to their trade line count. People just have them because they may help your credit score. However, if the authorized user account that you're on is maxed out, then you're defeating the purpose there. And then last but not least, there's certainly many free services out there that allows borrowers to review their credit report. You even have annual credit report that allows you, or annualcreditreport.com, that allows you to review your credit report from all three credit bureaus for free once a year. So take advantage of that because we definitely want to review our credit regularly for fraud. Make sure there aren't any accounts there that you don't recognize. It's very easy for that to happen, especially if whoever did it is still in the process of making the payments. But, at some point they would stop making those payments, and then that's when you will find out. So you don't want to wait till it's too late. So remember, we're always looking to be the loan consultant at the mortgage calculator. The reason that we think it's so important to understand what affects credit is so that you can properly consult your borrower. Don't just blindly look to refer them to a credit reporting agency a credit repairing company, let's say, where all they may be doing is just looking to take some money from the borrower and then never talk to them again. And then you could be on the hook for that bad referral. So always look to be the loan consultant and always look to assist the borrower's best interest.
All right. Thank you, Jose. I don't see any questions really, but let's see here. I hear Wayfinder is not going to be around soon.
I haven't heard any of that. Could be
I'm
true.
not sure. All right. Well, I don't see any other questions, so I guess we'll go ahead and wrap it up. Great info tonight, though. Definitely useful for everyone to know. Remember, we do this at 7 p.m. Eastern Time every Tuesday, Wednesday, and Thursday. So we will be back here tomorrow with a new topic. We appreciate everybody tuning in. We'll see you tomorrow, 7 p.m. Eastern, for the next